there everybody, welcome back to our channel. Today we are going to tackle how to plan and save for tax. This is a question that I get asked all the time from business owners. How to set aside tax and plan as I go along. It's extremely important to have an idea of how much tax you're going to have to pay. We are here today to alleviate the anxiety, to clear things up, and to hopefully give you some really great tips on planning and saving for tax. If this is your first time here, welcome. I'm Lucy Johnson, owner of Simplex Accounting. I am a fully qualified accountant and licensed accountant here in the UK, and I am here to hopefully get you organised. So without further ado, let's hop straight in. Let's go. Now, the first thing you might be wondering is, why do I need to plan and save for tax? The answer is simple: to save you stress, to save you the anxiety of the unknown, for cash flow planning, and knowing how much profit you've made within the year. These are all things that you want to know, right? So whether you want to know for your limited company or as a sole trader, I've got you covered. I'm really excited to go through some things that you may have heard and some things that you may not have heard. But most importantly, getting ahead, getting prepared, and making you dread your tax bill just that little bit less. I will be going over everything for limited companies, so corporation tax, sole traders including personal taxes, and even touching on things such as payments on account. So in this section, I'm going to be talking about corporation tax for limited companies. Please note that it's also important that you take into account personal taxes that may arise from your limited company, such as tax on dividends, which are taxed personally. This is the same if you take wages from the limited company. However, we receive something on these called PAYE, which means pay as you earn. So currently in the UK, corporation tax is applied to the taxable profits of limited companies. As it stands in 2023, the corporation tax rate is 19% for small profits and 25% for the standard rate. These details are shown on screen now and broken down further in our tax tables. You can download a copy below. So bear with me while I go all accountant on you. Below £50,000 will be taxed at 19%. Above £250,000, you'll be taxed at 25%. In companies with profits between £50,000 and £250,000, they pay tax at 25%, reduced by a marginal relief, providing a gradual increase in the corporation tax rate. So I know what you're thinking, that might be really confusing, or what, I don't know what my rate is. This is why I would suggest that you stick to 25% as a minimum and use the HMRC tax calculator to help. Please do remember that in order to keep all of these figures really accurate, your bookkeeping needs to be up to date in Xero. Then you can check in each month to see what your taxable profits are and set aside money towards your corporation tax bill. Your corporation tax bill will be ready to pay 9 months after your financial year end. So get your tax returns submitted as soon as possible for accurate savings figures. You want to get into the habit of going into Xero and running a profit and loss report to see your taxable profit. You then need to multiply that bottom taxable profit figure by 25% and save this amount aside in a tax pot. There are loads of great tax pots out there in lots of banks such as Starling, so get them set up and start saving. It's important to remember that there is a difference between taxable profits and accounting profits. So the profit that displays in the accounting software may end up being slightly different to the tax that is actually being declared on your tax return. However, this is a great rule of thumb and helps you to plan and save for the tax bill. This means that if the tax bill is more, then you need to top it up when it comes around to paying it. But if it's less, then great, you get to enjoy the surplus, take yourself on a holiday. Here I want to really reiterate a piece of advice that's important to me is preparing accounts and tax returns as quickly as possible after your year end. This means that in theory, you have 9 months to prepare for that tax bill. Now let's go on to personal tax. First off, I'm going to start on personal tax for directors. It's important not to forget that if you receive dividends from a limited company, you need to make sure that you're saving for personal tax on those dividends. As of 2023, there is an allowance of £1,000 that you can make tax-free in dividends. Once you've utilised that amount, anything above that is taxed at 8.25%. These rates are always changing, so please do check out our tax tables for the latest figures. And of course, the figures that are up to date as of today. This is part of your self-assessment tax return and your personal income, which is slightly more complicated than just a flat rate. But I will go on to explain this in the next section. Personal tax for sole traders. If you're a sole trader, you should be saving for self-employment taxes and personal taxes. Now, there's a lot more involved when planning and saving for taxes personally. This is for a number of reasons, which I'm going to go into now. One of the reasons is that every year we get a personal allowance. Now this year in 2023, the tax-free allowance that anyone can make is £12,570. This means that we can make this amount completely tax-free, and anything above that will be taxed. So immediately you can see that by taking your taxable profit and simply timesing it by 20% would not be accurate. Another reason is because with personal taxes, we have different tax bands. So if you go into a higher tax band, there is a portion of your taxable profits that are then needed to be taxed higher. Your personal situation could also be complicated. If you have a job under PAYE or multiple jobs like that, a pension, had capital gains, property income, or many other reasons, these could affect your taxes and rates of tax that you therefore need to pay. So these could push you into a higher bracket without you potentially even realising. HMRC has a great tax calculator, which I'll link down below. However, please do be aware that all figures are approximate and there will be adjustments for your actual tax. But hopefully you understand that this is an exercise to get you prepared and so that you can pay the tax bill, and hopefully to get you into some really great habits. There are lots of rules of thumb around saving for personal self-assessment tax, including saving 1/3 of your taxable profits. Another one is to set aside 30% of your taxable profit. These are very similar methods. This is really important because lots of people forget about things such as national insurance. So this can sometimes help for you to set aside that little bit extra and prepare as best as you can. Xero is a fully Making Tax digital compliant accounting software to help you run your business by sending invoices, creating expense claims, viewing reports, and helping you get paid quicker. It has a large variety of apps that you can choose from in the App Store, so any apps that you currently use can integrate seamlessly through Xero's App Store. HubDoc is used for any manual data entry, so these can include any kind of receipts and invoices as attachments on your transactions in Xero. You can also have fixed assets and inventory directly through Xero. Xero's main dashboard is really user-friendly, so it has your bank account, cash in and cash out, accounts to watch, bills that you need to pay, and invoices that need to be paid to you. Thanks Xero, back to the video. Next up is payments on account. So most self-employed people are required to pay tax payments each year on the 31st of January and the 31st of July. This is called a payment on account, and it is required for you to pay 50% of next year's tax on account up front. If your tax bills have always been less than £1,000, you would have just paid 100% of your tax on the 31st of January. Great. As soon as you go over this tax threshold, you will now have to pay 150% of the tax. This means that you've prepaid 50% of the tax bill to cover your tax bill next year. If in the next year your profit and tax is less than the payment on accounts that you made, you'll be due back a refund in January. If it is more, you will need to top up the tax in January and pay 50% of all of this year's tax for next year's. Here's a pro tip. A great thing to do is to submit your tax return as soon as possible after the 5th of April each year. Not only is it a great habit, but actually you may be able to reduce your July payment on account if your profits have reduced. And here are my final words of wisdom. The trick with all of these things is to get your accountant to submit your accounts and tax returns as soon as possible. Then, in theory, you should have your tax bill and 9 months to prepare for that tax bill. Please do go check out our latest tax tables with the latest rates on, along with our guide to planning and saving for tax. That has lots of helpful things to go through. I hope this video has been really helpful and made you feel just a little bit more confident about what you're doing. Please do let me know in the comments below if you are going to be implementing any of these tips. Now is your time to put it in writing and be accountable to getting on top of it. Please do hit that like, hit the subscribe button if you want to see more of my content to help you run your business a little bit simpler. All that is left to say is have a wonderful day and bye for now.